What is exciting to you these days in the tech landscape?
Yeah, well, there's a lot to be excited about. One thing that we do as an early stage venture fund, given that there's so much oversupply of capital, is to try to not chase the shiny object. And so we're really looking for places within the industry where technology hasn't quite created innovation yet. So, for example, logistics is one of these areas where we're seeing some incredible companies like Flexport, but there's a lot more opportunities for us to bring a little bit of data, a little bit of AI, connect a lot of great disparate sources together and make real change. One of our best performing companies right now is a company called Airspace that's doing just that, and we'll have more coming.
So leave the shiny objects to everybody else, these guys in their new fund. Commerce, infrastructure, security, fintech, AI, marketplaces.
Yeah.
Those are the hottest places to be in the years ahead?
Well, it's certainly the places where we're investing. And I think there's a lot of different strategies. And there are big billion-dollar funds that can throw a lot of money at companies that are using kind of the capital as a moat strategy to just try to get out ahead. And so what we're trying to find are places where data and software actually truly unlock a lot of value, where the unit economics make a ton of sense, and where we can really grow in an economic way. One of the things that we talk a lot about is that scarcity actually creates innovation. And I think we've been hitting on this point a lot here, is that if companies raise too much money too early, then they actually can just buy their future as opposed to actually innovate around what they need to do to create a great company.
We visited with you on one of our first trips out here, so it's been several months.
Yeah.
Now, as you take stock in the year that was out here, what do you make of all of it, everything that we've seen?
Yeah, well, I think there was a lot of conversation around when is the party going to end? And I think we've actually started to see some of the coming back down to earth, as you mentioned earlier, around, it shouldn't be growth at all costs. And not every company should be painted as a tech company. And so I think that's really healthy. As an early stage investor, we're typically investing in companies $3 to $10 million. The valuations are usually sub 50. But as those companies scale and raise money, where that hurts us is if they get way out ahead of their skis, raise too much money at too high a valuation. Then what happens is they have to do a down round. Early investors get squeezed. So I think everyone in this economy really appreciates more rational valuations and more rational growth.
Do you have a question?
I just think that, a lot of the thing you have to realize right now is a lot of the CEOs and first-time founders and CEOs today, they haven't been through a market downturn. So they're like, of course I'm going to go raise as much money as I can at the biggest valuation possible, because what could possibly go wrong? That's just setting me up for doubling it again 18 months from now. And, for those of us who have been through one or two of those, when it hits you hard and it comes at you fast, and you got to change course immediately. And as Adam said earlier in the show, you can't just, change your spending habits overnight. You got to work them out of the system. And so for people who haven't been through it, they're going to continue to make these mistakes until they get hit in the face.
Are you scrutinizing when you're giving me that first answer? I was thinking about, you must be, because you're at such an early stage. Yeah. You must be scrutinizing things more heavily. The business itself, the unit economics, but maybe more than anything because you're being sold on a story. Yeah. And it's the story that you need to vet more than ever.
Yeah, we need to believe that they're actually transforming an industry that has an incredible amount of upside. And the reality is that when we're investing, there's some data, but not a lot of data. And you get some early false positives. There are things that might show in the data that don't actually pan out. As early Series A investors, what we like to say is that they have hints of product market fit, but that you actually really have to dial that in. So we tend to work really closely with our founders about really understanding how are they finding their customers? How do we really drive better unit economics? And it's not throwing cash at it. It's figuring out, how do we create more organic growth? Yeah. How do we create a better sales opportunity? How do we create better retention? And so that's, having a product background, that's what I really love about, our opportunity to work with companies in the stage we're at, because those things all have to be relatively figured out by the time we're raising that next round.
A lot of early stage venture is, spotting those, what's the line? Spotting the good ideas that look like bad ideas, right? That's
almost laughable.
Yeah. And so how do you think about that? The person comes in and they pitch it to you. Look, I famously, or maybe not so famously, but it will be after this, I went for a trail run with Travis Kay in fall of 2009, and he asked me to put a little bit of money into the seed round of what was at the time called Uber Cab. And I told him it was a horrible idea, and passed. So, by the way, we didn't tell that story to LPs when we were out raising money for this fund. But, you know, how do you think about, boy, this sounds horrible, but the more you think about it or look at it from this other angle, the world will change and it'll be great.
Yeah, I mean, and that is always the hard thing about investing. I think earlier you were talking about fear of looking stupid. And in this industry, oftentimes taking a risk on a company at this early stage, you really do have to confront, gosh, I could look like an idiot investing in this company, because sometimes the most innovative large companies really are kind of crazy when you think about it in the early days. It's just not obvious until later.
The enterprise versus consumer space, you know, there's a great divergence in some of the performances of IPOs, you know, over the course of the year. How do you think about one versus the other, one sector, if you want to refer to it as a sector versus the next?
Yeah, no, I love this question, because I actually think it's kind of an old school way to think about the market. You know, what company is purely a consumer company? Even Facebook has enterprise sales on the back end. And so we've actually taken a fairly differentiated approach in that we look very broadly, and it's a spectrum. And in fact, many of our companies, you know, enterprise companies that sell to the end user, that's a consumer-like sale. There's this consumerization of the enterprise. So, you know, I think the key is when you look at consumer versus enterprise, we want to build profitable unit economic positive companies, and those can be consumer and enterprise.